July 22nd. In the news business, the tag end of July and August are known as the silly season because there isn't any news that amounts to anything, and so the news media have to print all kinds of stuff that isn't really news the rest of the year. So we're in the leading edge of that right now, and the broken record aspect is here we sit, mortgages at 3.5. The 10-year U.S. Treasury note 156, tried all week long to rise as high as 160 and couldn't do it. Yields overseas at 0 or below. And as crazy as this sounds, we are one bad accident overseas. Europe, Japan, or China. China, Japan, or Europe. Japan, Europe, or China. From foreign yields pulling us down further. Now, it won't happen as long as the U.S. economy is doing very well. And we're doing okay. We're not doing gangbusters, but we're doing okay. The completely crazy aspect of this is, as dangerous as the stuff overseas is, and as not dangerous as the United States is, we're really in pretty good shape. We are threatened more by events overseas than we are by anything domestic. It is possible that if yields fall overseas and pull our yields down more, that then we will go into overheating. And the overheating might have a center in the housing market. We are now theoretically 8 years into an economic recovery, but we really don't have anything resembling a strong housing market. I mean, it's on fire where we are, Boulder, Colorado. It's on fire in the Bay Area and other places scattered around the country. But if mortgage rates glided down from 3.5 to under 3, we not only have accumulated complacency in which mortgage rates haven't risen now for years and years, but if we actually went down to levels like that, we could wind up with the Fed having to do something about it. Now, the Fed still threatens to raise the overnight cost of money. That's the Fed funds rate. But raising that cost of money raises the cost of money to banks everywhere, not just here, but all over the world. And it does peculiar things to currency markets. There is a fringe theory or prospect. The Fed still owns almost $2 trillion worth of mortgage-backed securities that it bought during quantitative easing. The Fed's plan has been to gradually ooch up short-term cost of money, leave long-term rates alone. But if long-term rates come down in a way that overheats the economy, we may wake up one day to the Fed announcing, fellows, we've decided to begin to sell those mortgage-backed securities to make sure that mortgage rates don't fall too far. I don't want to alarm anyone on a hot summer weekend. It's not an immediate prospect, but it's a measure of just how crazy things are to have rates this low. I am still staggered that 2 weeks ago we set a new all-time low and didn't bounce up off it hard. We didn't. In the chart accompanying the copy beside this video, downtrend is still intact. There it is. Have a good weekend.